Welcome to Innovation and Leadership. I'm Jess Larsen. On this episode, we've got Ben Reinberg, founder and CEO of Alliance Consolidated Group of Companies. Ben, thanks for doing this.
Well, thank you, Jess. I really appreciate you having me on your show today.
I've got a lot of questions. I'm excited for the show. I'm interested, you've done so much in real estate. I was reading on the website, you've got over, that you own over 500 million in assets. What percent is real estate versus other things?
It's all real estate. That's my expertise. Since 23, I grew up in the business of commercial real estate. I invest in other things personally, whether it's technology, oil and gas, other, type of technology out there, blockchain type assets. But at the end of the day, commercial real estate is my passion. That's where I cut my teeth. That's where I invest heavily today. That's where my focus is. Between that and my personal brand, but my personal brand ties around commercial real estate investing and what I do. And so that's for me a way that I can give back, Jess. But at the end of the day, commercial real estate is really who I am as a person.
Yeah. So out of this last 28 years, it sounds like kind of last either 17 or 19 years, you've really specialized more in medical. Is that right?
It is. I mean, we're office, industrial, and retail experts. But 19 years ago, I was approached by a lot of my investors and said, okay, we're having trouble predicting what IRR really is going to look like on these deals. The internet is coming around. We don't know what assets are going to produce what. We saw in '08 and '09 the challenges of that environment and that economy, which I think we're going to have some troubled waters coming on next year. But with that in mind, we said, well, what produces stable cash flow and upside? And we looked at medical office. Medical office back then was being scrutinized. Barack Obama was in office. We thought we were going towards socialized medicine. We didn't know what was going to happen. And we said, the human body is never going out of style. So we said, with that being said, we're going to continue and focus on great products that produce cash flow and have the ability to provide upside. And so medical office kind of was developed. We started with the dialysis companies. The dialysis companies we saw were a really good niche. And so we did really well with that. And then this small investor named Warren Buffett bought 2.5 million shares of DaVita stock. And so we did a marketing campaign. We said, Buffett follows Reinberg when it comes to DaVita. And that kind of launched us in the medical office space. And we started rolling ever since. And so we started buying different types of medical properties with different tenants and really learned the business. And it's a very exclusive type asset and done very well with it. And so we continue today with our brand new fund, the Alliance Medical Property Fund, is specifically geared towards buying just medical properties throughout the United States.
So for people, maybe they've made their money in tech or some other business and they're looking at, maybe some of the shine coming off of venture stuff and they're concerned with what interest rates are doing to, other forms of real estate investing. What would you tell them about the nuances of investing in medical space, given potential some uncertainty here with interest rates or potential recessions and things like that?
Well, what's nice in our space is we can create long-term leases. And with long-term leases, you get long-term financing. And that's how you hedge against inflation risk. And so if you look at the assets we bought to date in the fund, 15-year sale leaseback type deals, 10-year financing on those deals, that's how you really hedge yourself against interest rate risk. So that's one way. Another way is stability. We have a high renewal rate. It's in the upper 80s on medical properties. That's historically what we've seen over the years. And so with that being said, you have stable cash flow. So our investments are really a safe, secure with profitability at the end when we sell the fund or sell an asset. And why is that? It's because these tenants have significant investment in their space. They provide a great service to each and every community that we invest in. We only invest in certain states that have great population growth, good healthcare markets, good policies. And so the lenders see that. And what's good for a lender is they see that we have great debt service coverage ratios in our deals. And so when you have the right fundamentals aligning with you, it makes it a lot easier to get financing, favorable financing. We're very good at having flexibility in our investments with our loans. And so at the end of the day, it creates great profitability and great security for our investors, Jess.
Yeah. So one of the things I definitely want to talk about is how you're using many of the modern forms of marketing. And like I was watching your TikToks today, okay? And there's a lot of folks that I was in investment banking with in 20 years ago who are not utilizing TikTok today yet. And so let's talk about this. You were talking about leasing costs for doctors these days, and how interest rates are scaring a bit of them when they've got such expensive medical equipment things, and that some of them are more interested in a sale leaseback and stuff like this. For people not from your space, let's just break down some of these terms. Like, what is a sale leaseback?
So a sale leaseback is we might have, say, a physician group or a tenant that owns the real estate and says, Alliance, which is my company, we want to use that capital to either redo our location internally, put some money inside the space, add some more equipment, maybe a new generator. Maybe we want to add another location to our portfolio with our growth. We might want to buy out properties. There's always a reason. So what ends up happening is they sell the property to Alliance. We end up creating a lease with this tenant, which is also the owner of the real estate. And generally speaking, most of our sell leasebacks are 15-year leases, annual escalations, and we pay a fair market price to the seller in order for them to achieve their needs. So the first step we do is we identify what are the goals? What are you looking to achieve? What are you using the proceeds for, Jess? And when we can establish that, we can mold a transaction that's beneficial, win-win for both sides. And then it becomes a great financeable transaction for us. The tenant has exactly the cash flow they're looking for. And because they don't want to keep their funds tied up in real estate. Owning real estate for them is not their best use of capital. They'd rather leave it to the experts to own the real estate and manage it. What they want to do is they want to enhance their business. And so they use the real estate as a way to provide liquidity that gets injected in their business. That's generally speaking why people do a sale leaseback.
And speaking of those injections, is this buying newer, better equipment, or preparing for the aging baby boomers, or what are the kind of things that they might be doing to deploy that capital they get from selling you the building?
Well, they realize if you think about this, Jess, this is an interesting set. There's more Americans that have health insurance today than ever. And so what that means is there's more growth. And so maybe more locations. It could be technology is changing quickly. It's expensive, this technology. You look at CT scanning machines and imaging machines and x-rays and the type of electrical they need in their building to support all these generators, especially with the weather conditions we see around the country. Now live in California. I didn't sign up for hurricanes or earthquakes, but I see that now. And so everywhere around the country is having different issues with weather. And so with that being said, you have to pay more attention to different factors that we didn't used to, that we weren't accustomed to. And so what that means is you need more capital. And more capital is something they need in order to stay competitive in their industry. So for example, there's always new technology in orthopedic, dermatology, gastro. Every niche has different types of technology coming out. And so at the end of the day, the sale leaseback transaction is really beneficial to them. They realize, hey, we have to be ahead of our competitors. We have to keep in touch with technology, and it's expensive. And so it's a different world out there, and technology is moving so quickly, especially in the healthcare space, and it gets expensive. And so keeping money tied up in real estate isn't really a profitable venture for these physician groups that we do business with.
So, I mean, it sounds like such a no-brainer. You've got somebody who already has a successful business in this location, so they're likely to stay in business long enough to fulfill that 15-year lease, right? This seems so great. Where do people go wrong buying buildings like this? What are some of the rookie mistakes that you see in people trying to follow in your footsteps?
What I see is the flexibility in the financing that they don't know how to finance a transaction, Jess, and that to me is something that I teach and a lot of people lean into because I am outstanding at financing deals. So they look for they're trading certain variables that are maybe less important because they're worried about the cost of capital. Maybe they overpromise their investors and they don't create the ability to hold. When you have the ability to hold in commercial real estate, that's what generates great profits because commercial real estate cash flows are like moguls. I'm not a skier, but if you're a skier out there, you know that the hills on a mountain go up and down. It's the same thing as a cash flow within commercial real estate. So when you hit the top of that mogul, that top of that peak is when you can sell, but you need the ability to hold. And so financing is critical because you need to create the ability to hold. Don't worry about, I tell people, don't worry about the face rate on the actual loan. Worry about the terms. Look at amortization schedules, look at prepayment penalties, look at the loan covenants, look at the decisions you can make. Where do you hold your funds? Do you have to hold them at the bank in an operating account, or can you hold them separately in your bank, which could be beneficial? There's a lot of nuances that go on in these deals, especially in this environment when people are refinancing and the lenders are tightening up. You have to have flexibility in your loans. And I see that's where people struggle is they don't know how to create the ability to hold and also have flexibility in their debt that they're taking on. The other thing that I think is huge, which we don't do, is people over leverage their properties. They're getting 75 or 80%. They're signing personally with recourse on these loans. And I think it's a real challenge because environments change. Interest rates go up and the values start dropping, and you have a certain amount of leverage and you can't refinance that 80 LTV loan. That's a challenge, Jess. And so for me, I always educate, especially younger guys in our business, don't over leverage your property. Don't take on mezzanine debt. I think mezzanine debt is a kiss of death. That's my personal view from my experience and being in the business for almost 3 decades. So you just have to be smart with your leverage. Leverage is great. It's the key to our business, but you got to be prudent with leverage.
Yeah. What kind of a LTV leverage do you like?
I like I like to be between 60 to 65%, 25-year amortization market rates, because when I have low LTV, I can negotiate a better rate. I can know better terms. Certain clauses I want uh, in my debt covenants. Certain rules that we need to adhere by to be good fiduciaries to our capital. So it's just experience. That's experience person game commercial real estate. And so being prudent with your capital stack is really important.
Yeah. So in addition to, percentage, how much you're borrowing against that loan to value percentage, um, I think there's a lot of people who maybe they have a 30-year mortgage on their home and, very sophisticated. They might be a CEO of a business in another industry and just haven't done real estate. And they don't realize, like, I remember a friend of mine, he was in charge of $35,000 of apartment buildings, right? And explaining like, hey, the rate is amortized at this, but I have to trade that debt. Like I'm gonna have to refi that debt. Like I don't have a 30-year loan; it's amortized for 30 years. And can you help people understand the difference there of when that, how lenders might need to be swapped out, even though it's amortized over a longer period of time?
Yeah, I mean, basically, at the end of the day, when you're refinancing, it's all predicated on value, whether it's a residential home, apartment building, a piece of commercial real estate like we own, whether it's industrial, office, retail, it doesn't matter, self-storage. At the end of the day, it's all about value. So lender's going to look at it and go get it appraised and say, okay, I'll give you an example. Let's say you bought a building for $5 million, okay? And your interest rate was, say 4.5% at the time, 25-year amortization, and loan comes due 5 years, they're going to look at the leases and look at the risk. And let's say commercial real estate is all based on income. And they look at it and they say, okay, well, the value dropped to 4 million. Okay. And let's say you took a loan out at 70% loan to value on the 5 million. So that's 3.5 million. Now the value of the building is 4 million. So if you take 3.5 million, okay, divided by four, your LTV is higher. That lender might say, we're not loaning on that asset. There's more risk. The value's dropped and your LTV is now higher. So what ends up happening? Well, you either got to go refinance it, could be a challenge. You might have to go redo some leases, which could be a challenge as well. Your tenants might not be amenable to that. And so what's that? And you're going to see that there's 1.4 trillion dollars of loans in commercial real estate coming due in the next 18 months. And so this discussion you and I are having is really relevant because what ends up happening is if real estate values drop, and we've seen that in some of our portfolio, and you have to refinance, the lenders are going to have to work with you because you can't like go to five other lenders and say, hey, I got this great property, they'll look at it similarly. Now, everyone's cost of capital is different. Interest rates are different for every lender. We're seeing that in this market. But at the end of the day, values are values. And if a value has a 10% variation where one appraiser says that in that example it's 4 million, one says 4.2, one says 3.6, again, it's a really tough road. And so again, don't over leverage your properties because when you do and you get in these situations, well, that's how you hedge your bet. Because when you buy a deal and you're amortizing, you're paying down principal, okay, and you don't over leverage it, guess what? You might be in this same situation and instead of, so at the $5 million deal, you get $3.5 million loan. Maybe if you took less leverage, you're now at 2.5 million or 2 million. So now you're at a 60 or 50% loan to value. Well, guess what? It makes it a lot easier to refinance it, makes it a lot easier to negotiate an extension with your lender if need be. And even if your lender's being difficult, guess what? They'll feel a little bit more comfortable working with you because they say, okay, I have some equity in here to play with. They don't want to take back the properties, Jess. They're not in the business. Everyone thinks like, oh, they're not in the business of taking back on commercial real estate. They want to work with you. They don't need the headaches. They don't want to hurt their borrowing capacity, and they don't want bad loans. So what they'll do is they'll extend the loan with you, and you work it out with them. And that happens a lot in our business. And so don't be afraid to have conversation with your lenders. This is why I'm a big component to go back to one of your other questions is to have good relationships with your bankers because when things are a challenge, you have to be able to pick up the phone and have a conversation. And it's why I don't do CMBS lending on our loans because I want to be able to pick up the phone and have a live body to speak to, Jess. I mean, because stuff happens in deals. Not life is not perfect, and it will never be in our business.
Yeah, and for people not in the real estate world, can you explain what CMBS paper is?
Yeah, CMBS papers basically mortgage-backed securities. So there'll be a firm out there, a bank or Wall Street lender where they issue bonds against your commercial real estate. And then they package that and then they create uh, money backed securities on Wall Street and they sell that into the open market. Well, the problem is the paper that your debt is on is being transacted in changing hands, or it could be with a servicer. It's very difficult to build a relationship and to find that exact person that handles your loan. And so what happens is if you have an issue or you're renewing a lease or there's something in a covenant that you want to have a discussion about, it's very difficult to get an answer and be able to work through any challenges you might have. So I'm not a fan of CMBS. Some people are, some people like it. I feel that I want a relationship. I want to, if I have a challenge in a deal at our company, I want to make sure I have a live body, a warm body I could speak to and build a relationship, and also have the ability to give them repeat business as well.
So CMBS, that's collateralized mortgage-backed securities, right? That's what it stands for.
That's correct. Yep.
And are people tempted to go that way because maybe they get a better rate on the face up front, and so they're discounting their ability to have a relationship later because they're only looking at the numbers? Is that why they do it?
It might be numbers. Some people can't get non-recourse financing outside the CMBS world like we do. It just depends on your experience level. Sometimes the rates, generally speaking, are really aggressive because they can get aggressive because they're portfolioing a bunch of loans. And so people look at it, and again, go back to my original point, you don't have flexibility in those type of loans. So you pick your poison. Would I rather, instead of paying 4%, if I could pay 5%, have more flexibility, develop a relationship, maybe repeat business, and be able to have that flexibility to be able to deal with challenges, you pick your poison. I like banks. I like insurance companies. I like folks I could develop a long term relationship with, regional banks. And so at the end of the day, that's how we do business at Alliance because, again, I'm a fiduciary for millions of dollars of investors' money. And to me, that's the most important thing that comes first. And flexibility, ability to hold and to develop relationships are what's going to create great investments for our investors.
So thinking about these banks or insurance companies that might lend to you for your property, what are the factors in the mind of the bank or the insurance company that get you over that mark of being able to get non-recourse debt?
You know, a lot of it is low leverage experience, great debt service coverage, great story, great product. It's a culmination of a lot of factors that I've been able to create throughout my career. When I was younger in my 20s, I signed everything with recourse. And I woke up one day and I said, I'm not doing this anymore. I have a family, I'm getting older, I don't need the headaches. And I realized, you know what, lower the leverage. Lower leverage, maybe lower the amortization so principal's getting paid down sooner. You can have a conversation and understand, okay, well, this is how we do business and this is what we're willing to do. And you work it out with your lender. You figure out what fits their space and it becomes a negotiation. It might be, your 65 LTV might go to 60 or 55. So you figure out what's important to you, or you might say, hey, I'm going to put more equity. Putting more equity in a deal is a blessing. People are like, well, it's going to hit my returns. Yeah, but you know what? It's going to give you the number one value, and that's the ability to hold. And so people are always looking at the numbers. The numbers can change. I think the biggest misnomer in our business, Jess, is people don't look at unleveraged returns. They look at, well, if I put leverage on this, I could pay my 7, 6, or 8% preferred return. Well, what happens if you had no leverage? Right? That's how you look at deals. That's how I was taught the business. What's the unleveraged IRR? What's the unleveraged return? Because debt should be able to help you instead of hurt you. And then you put leverage on it and you're like, okay, we just took that 8%. We can make it 11. However, we're not going to pay out 11 because we're going to be conservative. We're going to pay an 8, take that excess cash flow, build up reserves. Maybe there's tenant rollover, leasing risk, or whatever is going on, and now we're really going to protect the asset with leverage. So that's how I learned the business. That's what I promote and suggest to people. I'm conservative when it comes to investing. Uh, I like having a lot of reserves in my deals and the ability to hold. And it's why we have a fantastic track record with our investors. And we've been in business for almost 3 decades. It all comes together, that thought process.
One of my you remind me of one of my favorite investors of all time. One of the guys I think is about the best at taking Warren Buffett's investment principles and applying to real estate, Howard Marks. And he talks so often about how nobody gets fired in the good times because they didn't make quite as much as the other guy. Where people get fired is not being able to survive the downturns. He's
That's
like,
right.
if we can take care of the lows in the market, the highs take care of themselves. And he
Right.
thinks everybody has it upside down, and you sound just like him.
Well, you brought up a great point because someone asked me this. They said, well, who do you invest with, Ben? And it's exactly what you said and what Howard said. It's like, I want to know anyone can pay me a preferred return when things are good. But when times are tough or there's challenges in a deal, and there always is, something comes up it's unexpected. I want to bet on that horse, the person is solutionary oriented. My company Alliance, we are so solution oriented. We have 200 plus years of leadership team experience. Jess, we've seen a lot of different cycles. We've seen a lot of different issues and deals. What that does is when things are tough, we get in there and we tackle it and we aggressively tackle it. That's the difference. That's who I bet on when I invest with people. That's what I look for as an investor. That's what I would expect out of my company is when things are challenging, how are you guys going to rise to the occasion? And so what I love about my business and the point I am in my career, your skin gets so thick because you've seen enough. And if you can balance your emotions and your mindset, it's why I'm so into personal development because in commercial real estate, you see a lot of crazy stuff happen in your career. And you have to be able to emotionally balance the highs and lows. And so even if we hit a home run in a deal and I saw and it's huge profit, and let's say the IRR is like 32% on a deal and we have for 3 years and everyone's happy, I'm very even keel because I know not every deal is going to be like that. I know not every situation. I'm appreciate, I'm grateful, I'll celebrate the win and I'm excited, but I also know that over a course of a long career, things balance itself out. And so you got to be able to balance your emotions. You got to be able to deal with good people. You got to be resource rich. And at the end of the day, when you do the right things and you keep progressing and keep growing, you become solutionary oriented. And that benefits the investors because the investors don't see all the things that we deal with on a day-to-day basis. And you know this from running your own funds. They don't see all the minutia and all the wars that you had, all the battles you had to go through to get to the war to become successful. They don't see that. And they don't even care. They care about what you do lately for me, Jess. And so at the end of the day, being solution oriented, balancing your emotions, um, being in it for the long haul, which commercial real estate's a marathon business, there's no question about it. Those are the little things that create that success.
I'm interested in your estimation. What are the big changes when you go from doing tens of millions in real estate to hundreds of millions?
I think the difference is just staying the course, being that same person when you started, looking at the real estate fundamentals, not getting too big for your bridges, being humble, being a good listener. I think when the stakes are higher, you ratchet up your game. And you know what? You bring in incredible talented people to support you. I don't have all the answers, but I surround myself with great talented people that help me get to where it is. I think as you grow as a person and you age, I'm 53 now, you become smarter, you work smarter, you bring in talented people, you become a better listener, you work on yourself. You look at your deficiencies and you kind of laugh at yourself and say, okay, I screwed that one up, but we're going to learn and get better. So I think you become more financially and emotionally intelligent as you grow. And guess what happens? And the numbers grow with you by doing that.
Well, I want to talk about this because I think about, when you start to become really quite wealthy and people start to treat you different, right? And you can get away with not being humble. People will put up with it, right? You can get away with not listening as much. People will put up with it. And so it becomes like much more of an inside job, you know? And like, I think about like in my early 20s, I became a millionaire two different times, lost it all speculating both times, then became a devotee of Warren Buffett, right? And compound interest investing was, I'm dumb. It took me twice, right? But I remember being like, the guy who was making the most money in our friend group, right? And all of a sudden having all these staff, I'm like a 28-year-old CEO, and people treated me different. And like, I wasn't being compelled to be humble by life, right? Until I lost it all when I was, right? So now in life, I'm like, I look at the last 14, 15 years of like, how do I choose humility? How do I master myself? How do I not give in to temptations to feel special, to stop listening, to, like you say, get too big for my britches? So I'm looking for some expert advice from you on when when you don't have to be, how to get yourself to choose it.
I, I think you just don't forget where you came from. I'm a Chicago kid and I didn't come from money and I value it and I value the journey. And just my background is I'm very respectful to people. And what I learned in life is, because wildly successful people are very humble. They just are. I look at my peers and colleagues, like when you have nothing to prove to anyone, it's like to me, my biggest battle was being happy with myself. That was always my biggest challenge. I don't worry about outside forces. I don't worry about who has more or less money than me. A lot of things are material. Yeah, I love nice things. I like nice cars to drive and living in Southern California right now in a gorgeous area and
Where are you?
enjoying life. I live in Laguna
Oh, okay. I used to live in
and
Huntington and then San
my
Clemente.
oh, that's a great area. I love San Clemente. But in my office, my West Coast office where I sit is in Newport. And so I'm very blessed. I mean, I'm grateful. I step outside my office. I got palm trees and blue skies. And I'm across from Fashion Island. I mean, how could life be any better? I'm driving my Tesla through the mountains to get to work, and I get to see the ocean, and I get to see Irvine, and just gorgeous scenery and wonderful, incredible people that I get to interact with on a frequent basis. And then I get to go back to Chicago, where I'm from, and I get to eat great food and see my staff there in different areas of the country we do business with in different offices. So I I learned the word gratitude. And gratitude really, because if you think about it, Jess, you realize like, how did I get here as a 20-year-old? How did this all, well, it didn't happen because of Ben Reinberg. It happened because of a lot of people helped me get here. It could be employees, it could be colleagues, it could be family, it could be friends, it could be an interaction that you and I have that I have this aha moment like, oh my God, Jess just told me something I need to incorporate. So I learn from younger people too. I enjoy it. And so again, it goes with growth and mindset, and it goes with being the best version of yourself and being happy. And I just realized like it just doesn't serve you not being in a state of love. If you're in a state of fear, okay, that's when you become an ass and you're not listening and you're not respectful to other people. It just doesn't serve you. It doesn't make life enjoyable. So I just learned in life is I don't need to prove myself. I want to be the best version of myself. I compete with myself every single day. Okay. I'm my biggest fan and worst enemy. And I've also realized that I surround myself with people that support what I do and I support what they do. I have this,
Yeah,
creates this positive energy around me.
yeah. I'm thinking about this, like, um, just with the other, on the show, I get to meet, a lot of folks who built billion-dollar companies. Some of them are billionaires. With our charity, with other stuff, I get to spend some time in that community. We've had some partnerships, and like some of the most, like, I'll completely agree with you. Like some of the most humble and like biggest ears listeners I've met are these people. And then there's others. There's others that still have personal insecurities and kind of treat other people poorly, and like it happens, right? And as you're talking, I'm thinking, I wonder how much of it has to do with not accepting themselves. Like you talked about working to be happy with yourself. This is something I'm working on for sure. Is like no matter what I achieve, the the horizon of what's possible keeps going further out, right? And so I struggle with this idea of like um, acceptance and gratitude for where I'm at, balanced with like ambition, excitement about the future, without like a jealousy of the future of what I haven't done. And I'm always trying to like I that's a balance beam I'm trying to get better at. So I'd love some advice.
Well, I'll teach you something someone taught me, and she's a
Okay.
mentor of mine and a very dear friend. She said to me the other day, which I'll share with you and your audience because it's so true. It kind of touches on what you're going. I'll read this to you. People that criticize you are behind you. People in front of you don't criticize. And so if you find someone criticizing you or causing you issues, we look at like they're behind you in life. And so, for example, I'll give you an example. Let's say I'm into health and fitness. Okay, so let's say I'm at my gym, I'm working out, and say there's an overweight person, someone that is successful and is in great shape, empowers those people. You look at it and say, good for you. Good for you. You're showing up every day. Good for you. You're working on your weight and you're lifting weights and to really work on your health and fitness and lose weight and do everything possible you can. Someone that criticizes that person and judges that person is behind them in life. And that's how I look at it. And it's so true. And so where you see people are, maybe not humble, uh, it's because of an insecurity they have. It could be a rude experience when they're a kid. They didn't feel they're good enough. It's their way of projecting. And so a lot of that is an internal thing, like all of us. You see a lot of people's behavior, Jess, it's because of what's going on with them internally. I had to learn that. I had to work on myself for years, and I continue to do so today. It's why I meditate. It's why I work out on a daily basis. It's why I eat right and I'm healthy. I'm constantly working on myself because if I'm the best version of myself, I'm going to impact and create better version of people that I touch and impact. And I'm also a man of my actions. I don't like speaking and not back up what I'm going to say. And so I do that in my company is I could do any job in my company, okay, because I've done it. And so when I hear people complain, I'm not an excuse, guys. I laugh because I realize I did that job and I understand it. And I understand, excuses are just for weak people. And so at the end of the day, it's really when you see someone that's criticizing or you see someone that has to verbose how wonderful they are, I shy away from that behavior. Like I hate it. It's not who I am. And so for me, what I do is I don't include them in my inner circle. I want people more like me that are dependable and reliable and I can
Yeah.
trust. And it's just insecurity. That's all it is.
Yeah. What's funny is I would like to think I'm the person who doesn't criticize others, but it happens. And I'm sitting here thinking like that should be like my alarm bell of like that. that I'm that I'm behind them and feeling competitive for some reason, that it's some sort of self issue thing for me that I must not feel worthy or something, and it's like that's about me, and that I need to take a look in the mirror instead of looking at others, and I think it goes back to, I think one of my favorite things you've said in this whole interview is this idea of like it going back to love, right? Like if I can get to a place of love, I'm not going to be criticizing others, you know?
Well, there's a saying like, don't gossip about yourself and don't gossip about other people. And if you can do that, you'll have great success. And there's just no reason to. I mean, you have to look at it this way, is that everyone's out to fight for themselves. Everyone gets upset saying, "Oh, that guy's horrible to do business with," or this employee didn't treat me right. They're just doing things for their own intent. They're not thinking about hurting you. They're just looking out for themselves. And a lot of us take it like, "Oh my God, this person's hurting me." And I did that for years with employees. I was like, "Oh my God, I can't believe they're doing this again." And I realized it stemmed from me and my emotions and my behavior. And so I had to be, it's why my podcast, Ben Reinberg, I Own It, is doing so well because it's about owning every aspect of your life. It's about owning your behavior, owning your actions, owning your emotions. And a lot of us forget that concept. And to go back to your point, what's so important, Jess, is that take a step back and realize that we all have different DNA. We all breathe differently. We all look differently. We have different backgrounds and experiences. So I might have a lens of a situation that looks like this, and you look at it a completely different way. And it doesn't mean you're wrong, doesn't mean I'm wrong. We just have a different view of it. Like I see a green plant behind you. Someone else might look at it and say, it's really gray. And so, or it's blurry, or what, it's their view, it's their viewpoint of how they look at a situation. So it's why when you see like a police lineup and they have like five guys out there and they can't pick which one, because we all see and interpret things differently in life. Our human mind does that to us. And so when you can understand that and take a step back and say, let me seek the truth in what he's really saying to me or she's really saying to me, then you can look at life and say, okay, I get it. And that's where you don't judge people. That's where you don't gossip and you start loving people. And so when I interact with people and say someone criticizes me, I look at it as a growth moment. Okay, what was the truth behind it? Okay, well, maybe I didn't handle that situation right. Okay, so next time I'm going to learn from it, or I'm going to do something different, or I'm going to treat people differently. And
Yeah.
that's part of growth and maturing.
Yeah, I love the Stoic philosopher Epictetus, where he says, if we're criticized, to like ask, is it true? And if it is true, then we should change. And if it's not true, we should laugh about it, right? And
Right.
I'd love to talk about applying these principles to real estate. You're a Warren Buffett fan. I was reading the University of Berkshire Hathaway on the weekend. Guys who've been going to the annual shareholder meetings for 30 years, and they kept their notes that they sent to their clients every year. So it's like a book of it's not just historical. It's like, this was the note I took in 1992. So it's kind of a fun version of it, right? And it's funny how Warren Buffett is still saying the same things he was saying in 86 or 92, whatever. But he talks about this idea of like, so much of being a superior investor is not about being able to do math equations with Greek formulas. He says it's about temperament. It's about the ability to, not have everyone else's emotions become contagious, to make our own evaluation and stick to our own choices and things like that. And it seems like what you're talking about has so much to do with like the self-mastery to make it through the tough times, to hold things like that. Can you talk about that concept?
Well, if you think about Warren, and he's the master of this, and he talks about it, is you see how when things are being challenged in an economy or things are tough, he takes a step back, he looks at it, he has a methodical, logical way of looking at an investment, maybe a company, and says, no, this company's going to do well because here are the fundamentals why they're going to do well. Even though maybe the media or someone's hammering it, he takes a logical approach. He manages emotion and it allows him to make great decisions. Why he's one of the best investors of all time, a guy like that, is because he understands how to manage and look at reality and say, wait, let me take a step back and really process what's going on. And so I've learned in life, and especially in commercial real estate, that, you know, it's tough. Sometimes you'll lose a deal. Sometimes you don't win a deal. You put a letter of intent out. Sometimes, you have a vacancy in a property, a deal doesn't go as well. But if you look at it and say, okay, well, this is a marathon business, okay? And if I can go or 9 or 7.5 out of 10 on every deal, I have a hell of a career over a long period of time and I can survive. And that's how you become wealthy and develop a great business. And so, how do you do that? You have to be able to manage your emotions. Okay, that deal didn't work out just the way I wanted. Okay, I'm going to keep pushing forward. So in our business, commercial real estate, and a lot of businesses, and our business is so prevalent, is you have to be able to fail forward. You have to be able to accept failure. Look at when you're doing deals. We look at 80, 150 properties a week, and it's no, 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 no. Yes, let's look at it. Okay, we're writing an offer. No, we couldn't come to agreement. So how much defeat and failure is prevalent in commercial real estate? It's very tough. It's very tough to have a long career in commercial real estate. Why? Because there's a lot of failure just psychologically. And so you learn and ingrain is I have to be able to balance my emotions or else I'll never get to this point in my career.
Yeah. Well, maybe one final question that's a little more tactical for, again, people who don't get to do what you do all day. So, uh, DCSR or DSCR, debt coverage
Coverage
service ratio.
ratio.
For
Hmm.
people who don't understand like how that works with the like, yeah, but what's the property worth versus what are the cash flows? And, how is a calculation like that made?
So debt service coverage ratio is, let's say I have a net operating income. I'll make this an easy example. Let's say my net operating income after expenses is $2 at the year end. I'm talking about for a full calendar year. And let's say my interest and principal payments, what I call my debt service, is $1. So my net operating income, my profit is $2. My debt service is $1. So I have a 2-to-1 ratio. So a lot of lenders are looking for it. Depends on the environment. Some environments we've seen 1.2 debt service coverage ratio. We've seen 1.5, depending on deals. What I love about medical office and what we do is we usually have stuff over 1.5, which is great. And so what that translates to is if rent changes or if my debt service goes up from $1 to $1.25, that $2 NOI I was explaining, I still have a 75-cent delta margin to be able to make sure that I could pay debt service. So they look at those factors and they say, how much income am I producing? And how much is that borrower paying me? And is there enough room if changes happen? Interest rates go up. Let's say values drop. Let's say I have to lower rent. Is there enough spread to cover my debt service? And that's what they're looking at. It's basically a way to handle their risk and their default risk.
That's great. Um, well, before we finish up, tell people who want to learn more. Where should they be going on the interwebs?
Well, there's a couple ways. You can go to benreinberg.com. You can follow me. I'm on all the social media platforms. You could listen to my show, Ben Reinberg. I own it. It's from success to significance. We bring on celebrities and ultra high net worth, successful businessmen and women from around the world. And then feel free to go on my company. It's alliancecgc.com. That's alliancecgc.com. If you are looking to invest in commercial real estate and don't want to go through the headaches that I just described to you and invest passively, feel free to reach out to us. You can invest in our brand new fund, the Alliance Medical Property Fund. You can invest a little amount of money and have it diversified over a tremendous amount of assets and really diversify your risk, which I'm a big proponent of. I invest in what we do as well, so I practice what I preach. And those are some of the best ways to stay engaged with me. I'm on LinkedIn and all the social media platforms. So I'm out there. I'm easy to find. And if you DM me, generally speaking, I will respond back to you.
That's so great. Well, let's talk about your podcast for a minute. Who've been a couple of your favorite guests?
Well, it's interesting. I have a really great guest coming on tomorrow. His name's Orrin Claff, Pitch Anything.
Oh,
It's one of my favorite books and someone I admire. And it's interesting. I'm such a fan of his. I'm a little nervous to interview him tomorrow. I'm really excited. I've
he's
had,
done a lot of big real
Anthony.
estate deals, huh?
Oh yeah, he's wildly talented. I'm really excited to meet him. I've had I mean, every guest is special to me because I learned something from them. But Anthony Scaramucci was a great guest. Janine Driver was on my show. She was incredibly talented. Um, I mean, we've done over 200 plus shows so far in the can, and I interviewed last week Bedros Keuilian. He was on my show. He's wildly talented. I learned a lot from him. I've listened to his episode. I know it's a good show. When I go back and listen to the episode a couple times, I'm like, oh, I didn't think about that for work, and so I'll take notes. And Bedros was a perfect example. A wonderful person. Um, we've had different chefs on that are business moguls that are great and very successful. I had Tony Horton, one of the creators of Beachbody and P90X. We're launching him tomorrow. He has a new program coming out on Friday, which is really exciting. He was a wonderful guest. He shared his story of business and success. So everyone has on my show an incredible story, and we have people from the blockchain, commercial real estate, hotels, um, and it's incredible the lessons and the networking and the wonderful relationships you create with the people that come on the show. I just absolutely love it. I did not know a year and a quarter ago what I was getting into, and I'm glad I did. It's been a real blessing to meet people, and even I'm a guest on shows. I go on 2 or 3 shows a week, like yours, and it's great. And we get to meet and talk, and who knows, you develop a relationship, and I end up helping people, and they end up helping me, and so I really enjoy it. It's been a wonderful experience.
So I would love to hear your thoughts. So let's say there's a CEO listening. They've been thinking about starting their podcast. The networking, all this stuff looks, but they're like, but I'm so busy. Could it really be worth my time? And they're on that fence. What would you say that might put them over the edge?
Well, I thought the same thing. I still feel the same thing. You know, you don't have to do 3 or 8 shows in a week. You can determine how much you want to do, one a month, do once a month. You want to do once a week, figure out your cadence that's comfortable for you. You're not beholden to a certain schedule. It's all about input and output. If you want a great show and you want to put a lot into it, put a lot into it. If you want to use it for different measures, that's great too. For me, I wanted to do it because I wanted to help build our brand company and help my leadership team and our growth as we're scaling. And what I learned was it's actually something I really started to enjoy. And I got to meet great people. It was a way for me. I moved to Southern California. I really didn't know anyone. I came here from Chicago. I had to build up my network in addition to what I had. And so it was a great way for me to be able to build new friendships, new colleagues, new ideas and concepts. So for me, it was growth. So you have to, if you're a CEO out there or a businessman or woman, and you are considering a podcast, think about what is your outcome? What are you looking to achieve? And see if the podcast meets your needs. But again, time is everything. So if your time is precious and you don't have the time, then you don't have to do it. You know, it's really what your end goal is.
Yeah. Well, maybe a final question. There's so many people who have done well in real estate, and there's so few that have done as well as you. What do you think you've done different? What's special about you?
Uh, I care. I care about people. I put other people before me. I'm persistent. I don't give up. I don't believe in the word can't. I'm innovative. I don't believe in there's not a solution to every challenge. And I don't believe in the word quit. I don't believe in the word can't or won't or shouldn't. And I think it allows you to survive. And once you survive, you build relationships and you know you every year you get better and better and better and better resources and you continue to grow and you just can't give up. You just got to keep pushing forward and I don't think there's any recipe or success. I mean, it's like what Ray Kroc said in the movie The Founder, it's persistence. And it's so true. I mean, when he built McDonald's, and that's a Chicago-based company, so it's near and dear to me. I see a lot of Chicago-based companies. You know, these guys that become icons, the Ray Krocs of the world, you know, who you mentioned, Warren Buffett, they're persistent. They don't give up. They show up every day. They remember when they started. And that's the difference. And you just have to keep pushing forward because not every day is rosy. Not every day is a great day. But the fact is, the fact that you have every day to be the best person you can be, whether it's commercial real estate or whatever your industry is, if you take it, if you realize that and you're grateful for it, great things happen. So it's just constant having a routine and doing and showing up to work every day. And that's what I do. It doesn't matter who I am. I show up to work early. I stay late if I have to. I work out every morning. I have a routine, and it works for me. So figure out your routine, and you'll create success in your career.
I love it. Well, I appreciate you spending so much time with us today. This has been great.
That's fabulous. I appreciate you having me on.
Okay. Bye, everyone.